Happy Friday, everyone. We hope you've had an amazing week. You know who also has had a great week? It's Jay Pelosky. Like all the information that he gets on these sorts of things, these are the weeks that he lives for. How are you, Jay?
Well, mate, I'm doing fine. What's on the Barbie?
For everyone listening, it was a little bit of side action to see if he could actually do an Aussie accent and confidently can say that he can't.
I can't
But
exactly. I can do a Boston accent, though. We can park the car.
now, Jay, I've seen a lot of previews this week for a movie on Netflix called All Quiet on the Western Front. It looks amazing. I haven't had a chance to watch it, but did you get any inspiration from that from your title this week? Like the battle lines are drawn?
Actually, no, but it's funny you reference that because my son, my teenager, has already been to see it. He's 16, 17 years old and really into the martial things, the military stuff. So he's already been to see it. He loved it. So I can give you that kind of feedback. But no, the battle lines are drawn is the title of this week's Musings, and it really comes out of the press conference, right? Chair Powell's press conference this week. I mean, it's been a heck of a week for us. I mean, at TPW, we get the end of the month, we do our monthly. We talked about that last week, big deep dive, 20 charts and tables, 5,000 words. Then we update our models. Remember, we have our two global multi-asset model, which is our flagship, and then our TPW 20 thematic model. We update those in the first week of every month. So that was this week. And we send out a client letter and the whole thing. And then we do the musings. So the end of the month and the first week of the month are really busy here at TPW Advisory. So you add in the Fed meet and then throw on top of it the jobs number today. So we're like bugging out here at TPW Advisory. So we're very happy it's Friday for many reasons, which hopefully we'll get into.
Well, obviously, there's so much data out this week. Jobless, Fed, China making the turnaround, all sorts of different things. And as you said, it is a very busy period for you. What did you take away from the Fed?
Well, the first thing I took away, and you'll appreciate this because I know you have kids, right, is Chair Powell's amazing ability to get the market to do whatever he wants by listening to his words, right? Market was green when he started speaking on whatever it was, Wednesday. And within 20 minutes to a half hour, he flips it completely red. And it's like, listen to my words. I remember when my kids were young, now they're teenagers, I mentioned. When they were young, listen to my words was like the code, right? But it never worked. Chair Powell says, listen to my words. And markets are like the best behaved 4-year-old in the world. They do exactly what he says. So that was the first takeaway. The second takeaway was this issue of kind of asymmetric risk. As the chair noted, if the Fed does too little and inflation rips, they're in trouble. If the Fed does too much and tanks the economy, the Fed can always cut rates. Now we're well above the zero bound again, right? So the Fed can cut rates. So that creates an asymmetric risk in the eyes of the Fed. They'd rather err on the side of doing too much because they can always walk it back with rate cuts versus doing too little, which lets the inflation genie out of the bottle and creates all sorts of worries for the Fed. Now, what's interesting and why we use the term the battle lines are drawn is that there's a growing camp of opposition to the Fed's mindset, a camp that argues that, look, we have the best jobs market in 50 years in the developed world, not just the US at record low unemployment. Europe also has record low unemployment. Japan has very low unemployment, though that's kind of been the norm there for years. And so this body of work, and there are a number of people at the FT who we quote and reference in our musings. Adam Tooze, who's a very well-respected guy here at Columbia University in New York. He's part of this group. And there's pushback, and that's why we use the term battle, because we have a dog in the fight at TPW Advisory. Our view, we're with the camp that says, look, the best jobs market in several generations is worth preserving, particularly when you look at the political divide and the class divide that's taking place across all the developed economies. And so I think this is where the action is going to be, Scott. The Fed wants to make sure it doesn't let the inflation genie out of the bottle. No one's going to argue with that. But as it becomes clear inflation is coming down, as it becomes clear that the Fed's massive rate hikes have had effect, then I think there's going to be increasing pressure on the Fed to kind of declare victory, maybe even not declare victory, but can even continue to have nod towards the 2% inflation target, which, by the way, is completely arbitrary. There's nothing that scientific or economically supportive of 2% versus 2.5 versus 3. We think the Fed is going to kind of declare victory quietly towards 3% inflation in order to preserve that best jobs market in a generation. And that in turn will send a significant signal, obviously, to risk assets around the world.
Okay, so you've made it pretty clear then, like which dog you have in this fight then, right? Or am I missing something?
No, we identified the dog with the the dog with the tail that wags and says, "We like jobs." It's got a little sign on its tail. We like jobs. You should have seen it on the Halloween parade. Did you miss that dog?
I was busy with handing out candy out the front.
Oh yeah, no, that dog walked right by us down on near Flatiron here, and waved a head of tail sign attached to his tail. It said, jobs. Let's keep jobs going.
Well, to be honest, Halloween seems like such a long time ago.
I know, right? Like years ago.
I want to break just to the side just for a second from like what we've discussed beforehand, but China's had a very big week. Are you confident now in this move? Like we're trying to find a bottom here. Like I know Hong Kong had a very big day overnight.
Yeah, well, it just shows how one-sided the market is, right? I mean, all the markets are one-sided, right? I mean, we've been trained, and we've been writing on this for now well over a month, right? Our title last month was Extrapolation and Beyond, right? Then we wrote a piece in early October, actually the 7th, our first Musings was talking about two-sided markets. And I think we've clearly had that, right? October was a pretty good month for risk assets. So that was actually well-timed, that two-sided market musing, very well-timed. And last month and last week, we talked about China and the PBC reaction, right, where markets tanked because they don't like the lineup of the new Politburo. What's interesting is that we got a note from a woman who's a fund manager based in Shanghai and has run money in China for 15 years, one of the most experienced money managers in China. And she sent out a note this week saying that their view on the kind of new Politburo, particularly the potential new premier, Premier Li in potential, is a guy who they know well because he ran Shanghai and they like him. And they said he's actually very kind of up to speed on things like electric vehicles. He helped drive the new Tesla production facility in Shanghai, got that up and running in 10 months. So they're much more constructive on the leadership. And the way we think about it is that the deal in China is pretty clear. We provide economic activity and opportunity, and you, the people, acquiesce on the political side of things. And so it doesn't make any sense to us to think that President Xi, now in his third term, is going to deliberately tank the economy by, picking a bunch of people who don't know what they're doing. And in fact, when you really actually look at the new people in the Politburo, particularly the 7-member standing committee, they're pretty impressive backgrounds. Many of them are PhDs. They have engineering degrees. They're active. They've been active in government. And one point that I think is subtle but important is that these guys can plug and play, right? Because President Xi is in place. There's no need to kind of get people figured out. It's all plug and play. So that brings us up to the action this week, where there's talk of China moving off of zero COVID. That's all this is, right? And the market's moving 5-7% a day on that possibility. And I'm not sure what's going to happen, but we do feel and have written extensively that we do not expect any more of the 2-month type lockdowns that we saw in Shanghai. Our model, and we think the new model for China, is what happened in Chengdu, which is another big city, 20 million plus people. It was locked down for 2 weeks in the fall, early this fall. So they've moved from 2 months locking down Shanghai in the spring to 2 weeks locking down Chengdu in the fall. And that's the direction of travel. And so you can see the action, because the other really interesting thing, Scott, is you've got a bunch of things coming together, right? If the Fed starts to modulate a little bit, right? And if this week was the last 75 basis point rate hike, which we and the markets are suggesting it is, then the dollar can start to weaken and roll over. We expect that to happen. The dollar weakness then really gives a tailwind to both non-US equity and to commodities. And when you add on to that the potential for China to ease away from zero COVID and therefore start to price in 2023 a better growth profile in China, and you add on top the cherry on the top, JP Morgan reported this week that its global commodity inventory indicator, I think I got that right, is
Mouthful.
at a mouthful for sure, is at a record low for October. In other words, whether you're talking about oil or copper or iron ore, or certainly lithium or cobalt in the EV space, there's no inventory. And so lo and behold, PIC, which is something we hold in our global multi-asset model and have for, well over a year, PIC is up 8% today.
Wow.
That's it, 8%. Just a couple of these things may be starting to happen. And so when they do happen, and we think that's the direction of travel, again, battle lines are drawn. Fed is not going to drive the economy into the ground to get to 2%. It's going to kind of say our job is pretty close to done at 3%. That allows the economy to stay okay. That allows earnings to be okay. That means we don't have another leg down. That means that the dollar rolls over. Dollar rolling over and big cap tech going X growth in the US sets the stage for non-US equity outperformance, sets the stage for things like China, which has been completely oversold, to bounce and bounce hard. And if zero COVID does move, if they move off of zero COVID, we wrote about it, we talked about it. Alibaba, after the PPC meeting, Alibaba was trading at one-time sales. One-time sales. Now it's maybe at 2-time sales or 1.5. Could it trade at 3-time sales? Maybe 4-time sales? Of course. US peers are trading at 5, 6, 7, 8-time sales. And I do think that, the big thing, we're really focused on two things. And we updated the models, as we mentioned this week. And, one is if big cap tech goes X growth, where is that new growth opportunity going to come from? And we think it could be in the innovation space, right? Which is trying to base after an 18-month, 70% drawdown type of bear market, vicious bear market in that entire space, right? But if all of a sudden the market's saying, where's the growth? If Google and Microsoft and Apple are effectively going X growth because they're behemoths, right? They're humongous. To get new growth from them is difficult. Innovation could be the area of opportunity. The other area of opportunity is in climate, where, notwithstanding a lot of negativity about countries not making their targets, because COP27 starts in a couple of weeks in Cairo, a lot of talk about not meeting targets. On the ground, in the electric vehicle space, the battery space, the supply chain space, stuff is happening big time. And so that's another where in our TPW20, we have significant exposure to the climate space. And we think that segment is also really well prepared to do well in the next couple of years.
Well, you've touched on your portfolio there a few times in that comment. And obviously at the start of the month, we did the monthly last Friday, but
yep.
And we touched on some portfolio updates. And I'm always pushing for the viewers to find out more of your views and so forth, and trying to get a little bit extra information, if you would.
Yeah.
But I tell me if there's anything that stands out. Do you still like commodities, for example?
Yeah. Oh, I'm just taking a look at my notes, right? And I think what I would say is that we wrote last week about stability ahead, right? With the question mark, which you pointed out, definitely, still, raising the idea of stability ahead as we look at 2023. And if we have stability ahead, then I think we get a little bit more of a risk on appetite, right? And I know that the VIX is down under 25 as we speak right now today. It's below its 200-day moving average. It's at a 7-week low. So notwithstanding all the presser fireworks with the Fed, et cetera, VIX is at a 7-week low. The MOVE index for US Treasuries is well under its recent high. So if we get some calming of the macro volatility, right, that sets up the stage for the more traditional things like seasonality and models and analogs. That allows them to work, because we've had 2 or 3 years of ahistorical activity with COVID where that stuff hasn't really worked, right? History has not been a particularly good tell for investors here over the last year or two. And if calm, lower VIX, lower vol, lower macro risk allows these things to come back into play, what better way to see that happen than for a nice year-end rally, right? We're in the 3 best months of the year for equities. They tend to be even better in midterm years. And so you have guys like the folks at Fundstrat, very well respected, both fundamental and technical. Their technical guy is basically saying he sees an analog to 1962, which suggests another 10 to 15% upside by year end for US equities. So that's kind of the environment. And as we think about where do we want to go in our models, right, we've been overweight equities. That hasn't really been the right approach, but we've been able to kind of get some good selection in there, right? We've been long small caps in the US, big outperformer, long energy, big outperformer, long financials, outperformer, etc. We've been overweight Brazil in emerging markets, one of the best markets in the world. We've also been overweight China, which has not yet worked, but it's been that kind of year. Very hard, I think, for anybody to be like, just look at my whole thing and everything's been awesome. Very hard to be even on the right side of a few things, let alone everything. But so as we sit here, we're constructive into year end. We think the Fed is done with its front loading. We think the inflation data, even today's jobs data, we think pretty decent on the average hourly earnings to suggest, slowing labor market. That helps the Fed move off to 75. No pivot, but a step down to 50. That supports risk assets. And so we like to set up into year end. And then when we look into 23, we think stability ahead, lower macro risk, more traditional market work. And there you have, completely under-owned markets that are very cheap, particularly outside of the United States. We get that US dollar rollover. That's a tailwind for non-US equity. We like EM. So we like China. We like Southeast Asia. We like Brazil. And the things that we did this month, we didn't really do a whole lot because our portfolios are pretty well set for this. We've been waiting for this to kind of happen, this environment to start to, improve a little bit. We've been early, but I think it's coming. And in essence, the one thing we did, we added to biotech. Biotech is breaking out. Again, it's a play on where can we find growth, where can we find opportunity. So we like the biotech tie into the innovation space through the genomics. We also think that big pharma is going to be active, a lot of cash, and they need to replenish their drug pipeline. So M&A in that space is interesting to us. And by the same token, we expect to see big oil be active in the climate space. It's very hard to build a portfolio of renewables, and it's easier to buy them. And we expect, you see every day, right? President Biden wanting to slap a windfall tax on the oil companies, right? So they need to be doing something with this gusher of cash. And we think one of the things they're going to do is they're going to start to buy the renewable space. So we also added in that area a little bit, and then to tie into that in the industrials, which we think are interesting as a play on the nearshoring and reshoring that we're seeing go on in the tech stack when you think of semis, and also the whole electric vehicle supply chain, becoming very regional, very tripolar world, right? The supply chain in Europe, supply chain in the Americas, supply chain in Asia. Industrials very well suited to take advantage of that. And so that was another area that we've added to recently.
Okay, and then I'm going to sneak in one last question on you before we wrap up.
Be my guest, my
what's
friend.
happening?
I'm ready.
What's happening next Tuesday?
Next Tuesday. Holy moly.
Is it midterm elections?
That is midterm elections. Yes.
We haven't
I
even
don't,
touched on that.
I mean, I don't really think it's that big a deal. I mean, to me,
Okay.
the big deal on midterms is that markets do very well. It's unbroken since 1950. Midterm, the 1 year after the midterms, the S&P is up. Doesn't matter who's in the White House, who's controlling Congress. 1950, so 70 years of data. Every midterm year is up. And so, I mean, that to me is really the only thing that matters. Again, and as I said, if we can get some stability, if we move away from the crisis, the need to be dynamic with big action like the Fed or European energy prices or China's zero COVID, the three things we've been talking about. If we move away from that volatility, that opens up the space for things like seasonality and history and midterm and what happens in midterms to, you know, for investors to start to grab onto that and say, okay, then that makes me feel a little bit more biased to put some money to work. And right now, everybody's on the wrong side. You know, days like today, if we have, you know, if we get some continuation and break above 4,000 on the S&P, you know, if we see the dollar continue to weaken, if we see the MOVE index in US Treasuries, that volatility to come down, then markets, you know, things have lots and lots of room to move up, and lots of dry powder and people off sides and mispositioned to have that happen. And again, these are the best seasonal months of the year, November, December, January, and in midterms, they're better still. So, you know, we have been constructive and we remain constructive. And we think that kind of the wind is moving, you know, in our direction.
Okay, so well, let's wrap up then. Tonight, I would love to sit down and watch All Quiet on the Western Front, but I've got younger kids. It's rated R. So my youngest, he got knocked out of the playoffs last week in football. So is there any football we should be watching tonight, Jay?
Oh man, you're such a nice guy. I mean, that's that Aussie nature of just being a guy around the bobby. You know, yes, I have the exact thing for you. Duke football plays tonight on ESPN2, 7:30 versus BC, and it's a big game because if Duke wins, they become bowl eligible. They'll be the 6th win. They'll be 6-3 and eligible to go to a bowl. And so it's a big game. I'm going to be watching it. I'd love to have you watch it, and everybody who's watching us should watch it as well, and root the Duke Blue Devils on to football victory. Everybody knows Duke basketball, but we're trying to raise the flag for Duke football. And we think this team is a special team, and we're excited to see how they do tonight. Go Duke.
I look forward to watching it tonight, Jay. Listen, enjoy your Friday night and have a great weekend.
Thanks, buddy. You as well.
And for everyone else out there, good luck investing.